The year was 2008 and the world stood witness to a cataclysmic event etched in the annals of history. It began with a symphony of excess as greed danced with recklessness and risks were cast aside like forgotten whispers. Fueled by an intricate web of toxic mortgages and unfathomable leverage, the towering edifice on the financial industry teetered on the precipice of collapse. Like a colossal wave crashing upon the shore, the consequences rippled across nations, toppling mighty institutions such as Bear Stearns and Lehman Brothers to name but a few, and shattering dreams in their wake.
You see the same thing happening over and over again. When there's a financial problem, when the granaries are empty and the coffers are empty, they print money. And when they print money and the coffers are empty, it devalues money. And with that, when you have a large gap of people at each other's throats, then you create a risk of an internal conflict, a risk of some kind of civil war.
So today, America's in this huge bubble, this cash sitting everywhere. And the stock market's in a bubble, real estate's in a bubble, and all this. How much longer can it go? Today, America's the #1 debtor nation in the world. Every 90 days, they're printing another $1 trillion to cover the shortfall.
It's like $3 trillion federal expenditures are $7 trillion, federal revenue is $4 trillion. That's a $3 trillion difference in, if this was a company, it'd be a $3 trillion loss. So I don't know if we should be adding to that loss. That seems pretty crazy. Something's got to give. You can't just spend $3 trillion more than you earn every year and don't expect something bad to happen. I think, this is not good.
We are standing on the edge of the greatest financial crisis the world has ever seen. Trillions of dollars are at risk, and most people have no idea about what's happening behind closed doors of governments, banks, and corporations. But why? What are they not telling us about the global economy? And more importantly, what can you do to protect yourself? The global financial system is shrouded in opacity, with hidden risks lurking beneath a facade of stability. Let's dive into 8 interconnected points that reveal the true scale of economic dangers ahead and offer insights on how you can protect yourself. Since 2008, global central banks have injected trillions of dollars into the economy in an effort to prevent a global financial meltdown. More than $25 trillion has been printed to prop up markets, driving asset prices to unsustainable levels. Markets reached new highs, but beneath the surface lies a foundation built on manipulation, excessive liquidity, and artificially low interest rates. However, recent shocks, such as a 25% plunge in Japanese stock markets over 3 days, highlights the vulnerability of this system. It's hard to believe that such a significant event didn't result in a more severe consequence. In reality, central banks likely intervened with behind-the-scenes bailouts to prevent a collapse, highlighting how dependent the system has become on constant financial intervention. This house of cards can't be held up forever, and the cracks are now beginning to appear. Global liquidity has been critical to keeping markets afloat post-pandemic. For instance, the Bank of Japan has continued with its aggressive monetary easing policy, which has had ripple effects across the globe. Despite these interventions, the weakening yen and the volatility in the Japanese stock markets, they have raised concerns about the carry trade unwinding, a strategy where investors borrow in low-yielding currencies like the yen to invest in higher-yielding assets. The illusion of stability is starting to crumble. The global debt crisis is the linchpin in this fragile economic system. Global debt surpassed $300 trillion in 2023, a figure far greater than the combined output of the world economy. Much of this debt is obscured in off-balance sheet liabilities, making it difficult for regulators, investors, and even for the government to accurately assess this risk. However, the problem isn't just the size of the debt. It's the unsustainable borrowing that's underpinning economies worldwide. Historically low interest rates allowed governments, corporations, and households to pile on debt, thinking they could manage repayments indefinitely. But as interest rates rose, the cost of servicing this debt becomes increasingly unbearable. Many governments now spend more on interest payments than on critical infrastructure or social services. When rates rise further, a cascade of defaults is inevitable. The US government, for example, saw its national debt exceed by $33 trillion in 2023, and rising interest payments now consume a significant portion of the federal spending budget. Europe is facing a similar issue, with countries like Italy and Greece at the risk of defaulting if the European Central Bank cannot continue to keep rates artificially low. Emerging markets saddled with dollar-denominated debt are particularly vulnerable as rising interest rates increase the cost of repayments. While debt poses an immediate risk, the derivatives market represents a more opaque and potentially catastrophic threat. Valued in the quadrillions, derivatives are complex financial instruments that few outside of Wall Street fully understand. They used to bet on everything from interest rates to commodity prices and stock market movements. The problem is that the size of the derivatives market far exceeds the value of the underlying assets, creating a web of interconnected risk. During the 2008 financial crisis, we saw how derivatives such as credit default swaps amplified losses. Today, the market has only grown larger, and the potential for a systemic failure is even greater. If one major financial player fails to meet their obligations, it could trigger a chain reaction of defaults that would make the 2008 financial crisis look minor in comparison. One of the most underreported aspects is the yen carry trade, a practice where investors borrow in low-yielding currencies like the yen to fund higher-yielding investments. This trade is estimated to be worth around $200 trillion and has created massive financial leverage in the global markets. Should the yen appreciate suddenly, it could force a rapid unwinding of these positions, triggering immense losses and adding to the already precarious derivatives market. For decades, the US dollar has reigned supreme as the world's reserve currency. However, the dominance of the dollar is being challenged as major global economies begin diversifying away from the dollar. The BRICS nation, that's Brazil, Russia, India, China, and South Africa, are leading this charge, increasingly trading in their own currencies and stockpiling gold. In 2022, central banks purchased over 1,000 metric tons of gold, signaling a growing distrust of the dollar and fiat currencies. Many emerging economies have seen firsthand how weaponized US financial sanctions can destabilize their own economies, promoting them to seek alternatives. Russia and China in particular are positioning themselves as leaders of a new financial order, where tangible assets like gold and commodities back currency systems. Recent developments in China's digital yuan and Russia's acceleration towards a gold-backed currency highlights this trend. The US faces a crucial challenge. If the dollar's dominance fades, it would lose its ability to influence global markets and could face a severe consequence in the US, including inflation and a significant devaluation of their currency. Political tensions in the US could add to the economic turmoil. There's increasing speculation that if the current administration feels it cannot secure a win in the upcoming elections, they might resort to drastic measures, potentially dealing or even altering the election process. Historically, moments of extreme economic stress have coincided with political disruptions, and the US may be approaching such a turning point. The intersection of financial crisis and political instability could lead to chaos in the markets. Already jittery from inflation, interest rate hikes, and market volatility, global investors would react strongly to any major political uncertainty in the US. In times of uncertainty, financial markets crave stability, and any election disruption could further fuel an economic crisis that is already teetering on the edge. A new regulation is set to take effect in 2025, which will require all newly minted gold bars to carry a minting date, allowing governments to track and potentially control ownership of physical gold. This move raises concerns that governments are seeking greater oversight of tangible wealth in respect to the growing instability of fiat currencies. However, while this might seem like an effective control measure, It's worth noting that gold can be melted down and recast, making it difficult to track in the long term. As more individuals and institutions turn to gold as a reliable store of value, governments may face a resistance in trying to exert control over this timeless asset. In the era of increasing financial and political instability, the demand for physical gold is likely to grow as people seek to protect their wealth from government intervention and currency devaluation. While Bitcoin and other cryptocurrencies have been touted as a future of money, decentralized and free from government control, there are a growing concern about their actual privacy and stability. Bitcoin transactions are traceable through the blockchain, and as governments explore ways to regulate digital currencies, Bitcoin's original promise of financial freedom may be fading. On the other hand, gold remains a tangible asset that has served as a store of value for thousands of years. Unlike Bitcoin, which is prone to wild price fluctuations, gold's intrinsic value is recognized globally, and it cannot be created or controlled by governments in the same way digital currencies can be. While Bitcoin has speculative value, its volatility makes it less reliable during times of crisis. Gold, on the other hand, has proven to be a hedge against inflation and financial collapse, offering stability in a world where fiat currencies and cryptocurrencies face increasing scrutiny. The global financial system is on the verge of a collapse, but while this might seem like a doomsday scenario, it also presents an opportunity for those who are prepared. Historically, in times of financial crisis, tangible assets like gold and silver have been the ultimate safe havens. They offer a store of value that remains resilient as fiat currencies fail. The collapse of fiat currency systems isn't a distant possibility. It's already underway in various corners of the world. Venezuela's hyperinflation, Turkey's devaluation of the lira, and Argentina's repeated currency crisis serve as an early warning of what may come for larger economies. The time to act is now. Diversify into tangible assets, hedge against inflation, and protect your wealth from the systemic risks that are about to unfold. As central banks around the world quietly accumulate gold and other real assets, individuals can follow suit. Real assets like precious metals, agricultural land, and essential commodities will retain their value long after fiat currencies collapse. It's not just about surviving the financial apocalypse, it's about positioning yourself to rise from the ashes stronger than before. The journey from systemic financial manipulation to geopolitical realignment and a looming financial collapse reveals a clear message. The global economy is more fragile than ever. The key takeaway is to take action before it's too late. Those who prepare by moving into real, tangible assets will not only protect their wealth, but also position themselves to thrive in a new economic order that emerges post-collapse.